September kicks off with a weak start on Wall Street. Welcome to Market Insights. I'm Peter Devlin. September has been historically a bad month for stocks, and this year started with no exception. The VIX index, known as the Wall Street Fear Gauge, has spiked, and there are more sources of potential volatility to come this week. That includes the US jobs report on Friday, closely watched by investors worried about a potential slowdown in the US economy. So is this annual volatility or more serious alarm bells ringing? So joining me now to talk about all that is John Stoltzfus, as Chief Investment Strategist at Oppenheimer Asset Management. So welcome, John. Starting off with the sell-off yesterday, it was sparked by the weak ISM manufacturing prints. So are recession fears warranted?
You know, Peter, I don't really think so. I think if anything, it is almost a prerequisite of the market getting prepared to see numbers like the non-farm payroll, and ahead of it, the continuing jobless claims, the initial jobless claims, and today it was the jolts that kind of spooked the market for a bit. But overall, I think it also has to do with seasonality and also the fact that we've had a tremendous rally since August 5th, the lows that we had there through the end of August, a really rather fabulous broad rally. So it's just a haircut or a trim is not a major market decline.
So again, the epicenter of the selling was in chip stocks, with Nvidia sinking by a record $279 billion. Is it time to reconsider the AI frenzy?
You know, Peter, I always think it's always important to reconsider a frenzy and the aspect of any kind of froth or just blind buying on the part of investors of a particular thematic always concerns us. But in the case of AI, once you lift up the hood on what's going on, it really looks to us like we are at a watershed point in terms of technology, an entire change in technology, boosting in its importance. This doesn't look like the tech bubble. I've been in this business for 41 years, so I can well remember the tech bubble. And this is not the tech bubble. That technology was relatively primitive versus where we are today.
So John, you did mention that NFP print due out on Friday. Jolts as well, falling to their lowest since 2021 today. What are you expecting for Friday's NFP?
Well, you know, when we think the general number, as I recall, somebody's looking for about 165,000. We'd be happy with about 150,000 in terms of jobs. But we'll say this. That number tends to be a volatile number. It's subject to seasonality, and really you need to look at it over at least a quarter or 2 quarters to get an idea of where it's headed. But it doesn't look at this point as if we're headed into a recession, but rather at a point that will likely justify the Fed to perhaps cut as much as 50 basis points in September, though we'd be perfectly pleased with 25 bips in September, followed by, if needed, 25 basis points cut in November and another in December.
So we did see some bolstering of bets of a jumbo rate cut from the Fed this month. So are you resolute in your call for 25 base point cuts, or could you move?
Oh, you know, we always want to stay flexible in terms of judging the data as it comes across the tantrum. But at this point, we would say the Fed has done a remarkable job since March of 2022 in the sense that it has brought inflation down from untoward levels, which were at 40-year highs, to much closer to its 2% target. Even though the 2% target remains elusive, it would appear with the effects that monetary policy has as lagging, we would have to think that in anticipation of the need for a rate cut, to take 25 to 50 bips now wouldn't hurt.
So just finally, John, in July, Oppenheimer raised its target price to $5,900 for the S&P 500 by the end of this year. That was the second most bullish on the street. So are you still overweight on US equities?
Yes, indeed we are, Peter. We're still overweight equities. We started this year with a target that we'd initiated for this year for the S&P back in December of 5,200. As I recall, it was exceeded in March. We raised to 5,500, and then in July went to this 5,900 target. We think it's a practical target. At this point, we always look to the markets to give us an idea of how our target looks to be achieved in the space of time we're given. But right now, the fundamentals overall look much better rather than worse. And the uncertainties remain that remain on the landscape, so to speak, appear manageable. So 5,900, we'll stick with that for now.
Is there any movement for it to move higher by the end of the year?
You know, it's always possible. I mean, when we put in the 5,200, we thought I think at that time it was the highest on the street, if not tied for the highest on the street. And at 5,500, gosh, we thought we were, being very realistic but conservative. At 5,900, we feel comfortable. We can't help but think that a 6,000 target might be a little bit of a psychological hurdle for the market to make this year, with thoughts that it might very well do it next year. But you never know. We'll stay tuned, and we'll be actively watching what investors do, and also what the economic data and what monetary policy does.
John Stoltzfus at Oppenheimer Asset Management. Thank you very much for your thoughts. And that's Market Insight. Don't forget, you can watch more videos on Reuters.com.